Hey everyone, hope you're well and hope you've had a good start to the weekend. So today I wanted to go over a particular mechanism you can use to gain passive wealth and use it to fund particular expenses in the future, potentially covering all your expenses and allowing you to retire early. So if you haven't already, please subscribe and hit the like button and we'll move on to talking about dividends. Hey everyone, thanks for sticking with me. My name's Ben and today we're going to talk about dividends and how they can benefit you potentially in your investing strategies. The best place to start would potentially be with what are dividends, and dividends are just a distribution of wealth from the company to their shareholders. They do this instead of using the excess revenue to benefit the company. A lot of companies like blue chip stocks and companies in that sort of area you may find don't grow as quickly as new startups or potentially some tech companies. This is because they've already expanded relatively largely into their areas and they don't find much use for millions and millions of pounds left over to make the company better. In these instances, what the company will do is actually pay that out to the shareholders in the form of a dividend. The shareholder can then either purchase more shares with that money or use it to subsidize their living amount and pay off rent and bills and things like that. Due to this, generally tech and startup companies will not often pay a dividend because they can reinvest it into the company and they will repay equity to the shareholder through share price inflation. It's worth noting that there are other mechanisms enabled to withdraw this wealth as opposed to selling it in the same form of dividends. This tends to be ETFs and distributions. What happens is when a company within an ETF makes a dividend, the ETF will actually hold that dividend and generally on set dates pay out a distribution to the shareholder of all the accumulated dividends from the companies. The other option is Reits and Mlps, which you can generally buy on the stock market the same as other normal companies, but these are actually structured in a different way and what they have to do is pay out the majority of their earnings as dividends. Regardless of how you're actually claiming your revenue back in the form of dividends or distributions from ETFs or REITs, it is still going to follow the same sort of process and we're going to go through that now, so stick with us and we'll break down each of the main stages that matter during the dividend process. First, we have the announcement date or the declaration date. This is the date in which the company goes out and formally declares that they are paying a dividend. On that date, they will issue all the required dates for people to be aware of, and they will also post the amount that they are intending to pay. This goes out publicly, so multiple people and everyone in the stock market is aware and can choose to buy shares or hold shares or keep shares based on that information. The next important one we have is the ex-dividend date, or people for short call it the X date. This is also similar to the record date that you'll see. Generally, these two dates tend to align. And what this date is the date that you need to hold the stock by in order to claim the dividend. Please note that I mean held it by then, so you have to have normally bought it at least the trading day before the ex-dividend date. As an example, if you were looking to buy a company and their ex-dividend date was the 23rd of March, to qualify for the dividend payment, you would be looking to at least buy it by the 22nd of March and therefore would qualify for the payment. If you bought it on the 23rd, you would not get the payment benefit of the dividend itself. And then finally, we have the payment date, which is the one that a lot of people like to come around more often than not. The payment date is the date that the company will release the funds. This then goes to the broker, which tends to pay it into your broker's account. It is worth highlighting that not always will the money actually enter your account on the same day as the payment date. For example, if you're using a ISA in the UK, there may be a slight delay as it has to go through some additional checks depending on the company and the source of the dividend. And that is how dividends are pay structured generally. A company will declare them, you have to hold it by the X date, and then you get paid it roughly on the pay date. That's how you will accrue dividends if you wanted to do so. And there are a few more nitty gritties that we're going to go over in a moment. Now, when a company pays a dividend, there are a few fundamental things that will happen at that particular time. The main one of these that you may not be aware of, but does take place, is the actual drop in the share price. What happens is because the company is paying a dividend, the share price drops by the equivalent amount of that dividend on the day of the ex-dividend date. As an example of what I mean here, if there was a company trading for £100 a share and it was due to have an ex-dividend date on the 24th, on the 23rd it would close at £100, and then because it was paying a £1 dividend and the ex-dividend date was the following day, it would open the following day with £1 taken from its share price. It is worth noting that this won't show up on the change throughout the week or the day of the stock, because the dividend is treated as never being there in the first place. Because of this, it can be useful to remember that on the particular day of the next dividend date, the company will be trading at a percentage lower than normal based on the amount of its dividend. So you may want to take advantage of that. Now, you might be sat there going,
but Ben, what's the point in dividends if the company share price is going to drop anyway? Surely I want to just keep the company growing and claim it all when I sell my shares.
And to that I would say yes, but also no. Depending on your situation, it may actually be better for you to keep it in a company that will return it via growth. If you're in a taxable account, for example, you may want the company to grow rather than pay you out a dividend, because you'd only get taxed on the capital growth when you sell the company, as opposed to every dividend payment they pay out. However, on the other hand, it's worth noting that by getting paid the dividends, what you are managing to do is reclaim wealth from the company without actually diluting any of your position. So I am going to go over a chart in a moment that I hope will evidence this. It is going to be very simplistic on the data side, just to make it easier for me to format. However, let me know what you think, and I'll kind of back the case for dividends being equally, if not better, than growth stocks in general. However, don't discount growth stocks. They are a very good way to make a lot of money, even in a short period of time, depending on the company. There are pros and cons to both. However, I'm going to explain from my point of view, which is using a tax sheltered account. And if you're using a similar sort of account, this may be of a benefit to you. So I'm going to quickly jump into a spreadsheet and we'll have a look at the differences between a growth company and a dividend company on an equal basis. So I'm going to quickly go over a spreadsheet where I've tried to simplify a situation on an equal footing with two companies. One would be paying a dividend and you would be trying to live off the dividends, for example, and the other one would be a growth company, and what you'd be doing is selling a percentage of it every year or every month, however long the period is, to fund your lifestyle the same as you would in the case of the dividends. If we take a quick look over the spreadsheet and we walk through it, we can see the difference between recouping cash via the dividend rather than selling off part of the company due to growth. If you bought one share of the company for £10, let's assume the share price grew consistently for 10 years at 5%, and you wanted to pull out 2% of the share price every year through selling the company. So after the first year, your stock price would go from £10 to £10.50, but you recoup your 2%, so you'd sell 0.02 of the company and claim your 20p. The following year, the share price has grown to £11.03. Again, you sell 0.2 of the company to claim your 2%. And then we follow this all the way down the chart, and you can see at the end of the 10-year period, the share price has grown to £15.51. However, you have sold 0.18 of the company. Because of this, the value that you hold of the company is only £12.72p. However, if we flip over to the same chart but mapped for dividends, we can see at the end of the first year, the company has only increased to £10.30 but has paid out 2% dividend. This has reduced our overall value but has kept the amount of held shares the same. Again, we work all the way down the chart and we can see that the final share price is only £13.05 compared to the past method's £15.51. However, if we look at the actual held value based on the company and the amount of shares we hold based on the share price, we can see that the one dividend share is worth more than the 0.82% worth of the sale method. If we total both these methods up, we can see that the dividend method you end up better off by 10p once you account for the dividend and sales payments. Obviously, the other advantage to a dividend company is by receiving the payments without having to sell your stock. You will never run into a position where you've sold too many of your stocks for the amount that you need to return, whereas you could run into, in theory, an issue where you're selling all of your stocks to pay for your lifestyle and eventually run out of the ability to do so. I do want to add here that this is a very unrealistic situation for both of these companies to grow in exactly the same way. However, I've just modelled it this way to show that on a complete even footing, dividends do have an advantage. So the next point that I wanted to raise is kind of one opposite to what I see a lot of people saying online, and this is around, do the payment of the dividends matter? So you may be sat there now going,
Ben, does it matter to me if a company is paying 4 times a year, 12 times a year, once a year? Does it matter if I buy before their ex-dividend date or wait a year and buy it just after? What's the best way of doing it?
And I can't really answer with the best way of doing it, but I can explain why I prefer companies that are near their ex-dividend date rather than buying ones that are a year or so away where possible. There seems to be a lot of YouTubers out there that have the opposite point of view. I think even Andre Jick did do a video around how it doesn't matter if a company is paying you yearly, monthly or quarterly, and I do slightly disagree on some fronts of that, and I will explain that through hopefully a chart that makes a little bit of sense. So while it's true, if a company's paying a £1 dividend throughout a year, you're going to get £1. The value is still going to be £1, regardless of whether they pay it in a couple of days, in 6 months, pay it through 25 pence sections 4 times a year. It doesn't matter, it still equals £1. So do payment schedules actually matter? And my answer to this is yes, majority of the time. And my reasoning for this is the actual opportunity cost of those dividend payments. And I'm going to explain it with this spreadsheet that I spoke about earlier, and hopefully it will again break it down in a very even manner, and we'll hopefully see the difference based on a company that pays once a year versus a company that pays monthly. So again, we'll jump over to a quick spreadsheet, and this one we're going to make a couple of assumptions. We're going to assume that we've got a company that's trading at £100 and it maintains that level through its entire life. It doesn't grow or drop, or should I say it averages out. So when it pays a dividend, it increases back up to the £100 and it just generally stays there along the line. This way we can kind of get an even balance. I appreciate it's not a situation that is generally going to arise, but we should get an even balance on the difference between the companies. So looking at the chart, for ease, we'll make a couple of base assumptions and we'll say that you've bought 1,000 shares of the particular company and they pay £1 dividend per year. You know that they've just had a ex-dividend date, so you're buying it now and you'll get paid out in roughly a year. The year goes by, and at the end of the year, on the payment date, you receive £1,000 for your 1,000 shares at £1 a share. You could then take that £1,000, nice and simply invest it back into the company and receive a further 10 shares. So your position is now 1,010 shares, and that will pay out on your next dividend run in the following year. However, let's flip this over and we'll look at it from a monthly dividend paying point of view. So moving over and looking at the monthly dividend option, we can see that you'd buy it originally for your same 1,000 shares, but for your £1,000, it's split across monthly payments of £83.33. Because of this, on the first month, you can take that £83 and fractionally buy 8.3 shares of a company. This would then mean that on the following month, providing that you bought them before an ex-dividend date, which is potential, you would then receive £84.03 rather than the initial 83.33. You could then use this to buy another 8.4 shares of the company ready for the payout date the following month. If we follow this all the way down through the end of the year, we can see that you've acquired 4 more shares of the company by the end of the 12-month period. This would essentially equate for £40 in cash additional that you have spent on the company, but also means that you would be on a yearly basis getting paid out more on a continual rate than the company that gets paid out once a year. Obviously, the more amount of money and the further you run out this model, the worse it gets for the yearly payer over the monthly payer. And essentially what this is the opportunity cost of not buying the dividend. I will say that if you were to buy a company and it paid out its full year and you bought it just before the ex-dividend date, that is also a potentiality because you can then reinvest those back in. However, the constant flow of cash seems to, in most cases, actually counteract the rewards of the other methods. And that's because the longer you have the money using it for your benefit, the more you're going to get out of it. As I did say, these are rough models that take a lot of stuff out, so there isn't any price variation and stuff like that, which you would account for in a normal model. However, it's just to give a rough breakdown on an equal footing, comparing monthly paying and yearly paying. Again, this mainly is preferable for me in a tax-free account. If you were being taxed on your dividends and things like that, you may want to consider growth options instead. The main reason for this is you will only get taxed when you sell them rather than every single time, and that might be preferable in a financial manner. But the next time someone stops you and says that there's no difference in a company paying out its dividends monthly, yearly, bi-yearly, or any difference in dividends being paid out at all, hopefully you can refer them back to this video and some of the evidence I provided will help fight your cause, and it may also enlighten them and make them find dividends a bit more appealing. I personally like the idea of being able to put the money in and reclaim it over time and then potentially use that to pay some of my bills in the future, in the far, far future, but in the future. So let's have a look at that. I will point out again that companies aren't bound to pay them. Most companies try to pay them regularly, but there is no guarantee to them. However, there are companies that have paid uninterrupted dividends for 20 to 30 years. So I think that's a good standing if you're buying companies like that. So now you know the majority of what you need to know about dividends to be able to get started. I am going to be going over future videos around dividend growth investing and general dividend investing and how you can apply dividends to your portfolio and things that I've read about, found out about, personally used. However, for a base underline of how dividends work and how to reclaim the value, hopefully this has helped. And if you want to get to grips with valuing potential dividend companies, I have got a video which should hopefully be appearing now, which you can click through to, and it will explain a potential way of valuing a company that does pay dividends. And thank you for watching, and I'll see you next time. Goodbye.